As of recording this, Bryson DeChambeau just won the US Open. That is my GOAT. Look, this is a trading channel, but golf is very similar. It's just you versus you out there. I think I can go pro by buying my way to the top. But hey, this video is about smart money concepts. I'm not only gonna make sure you know how to chart and analyze this, but also how to use it for actually trading. I don't cook ever. Look at this positive right here. After this, you're gonna know all the lingo so you can sound like a beast on Twitter, so smash like. You hear these buzzwords like liquidity sweep, order block, fair value gap all the time. I do think smart money concepts are kind of overrated. You're basically just going deeper into supply and demand, but I do know a bunch of people that have a lot of success with it, and I do trade supply and demand, so I do implement some of this stuff myself. But no matter what, I think it's important that you know and understand it just in case of one situation where it might help you out. Commonly known as the most sus statement in the entire trading community, the liquidity sweep. This is kind of the forefront and the foundation for the entire smart money concepts ideology, I think. It does sound cool, but in reality, it's nothing crazy. A liquidity sweep occurs when significant market players execute large volume trades that trigger the activation of pending buy or sell orders. The concept of smart money trading is you are trying to reenact the moves of the institutional market. The market is moved by the people with the most money, like banks and hedge funds, and there's the retail side of the market, people like me and you who try to trade the market. This is all based on the institutional side trying to take advantage of us. You're trying to replicate the institutional side to make sure that you actually catch the move. Basically saying the institutional side is trying to take advantage of the retail side of the market. Liquidity refers to how easy an asset can be moved. Something like the S&P 500 is very liquid because it can be moved very quickly, whereas Home Depot stock doesn't really have a lot of liquidity. But in this case specifically, liquidity sweep refers to the amount of open orders there are on a certain thing. This is a real example about how I got fucked on Friday due to a liquidity sweep. And just to show you guys the real life scenario, this actually happens in live market sessions. That red zone was based off the previous high of the day. You can see right next to it. This trade wasn't directly affected by a liquidity sweep, but, and this is hindsight, so it is kind of different to look at, but you can see right before I took this trade, there was a nice uptrend. And anybody that was in shorts during this uptrend would target that high as their stop loss, because anybody with the right mind, if there's something breaks above the high of day, it's a pretty good sign that this is probably going to continue higher and I'm going to lose all my money if I stay in shorts. So market investors will set their stop loss at that high of day knowing that. And you can see we broke that high of day and instantly swept 20,000 points back down right into another liquidity sweep. You can see right there. Don't look at the text on this shit, but this is what you want to look for. Charting out key levels of price, waiting for a break of them and a sweep of liquidity, then looking to take that trade. Final example, that first candle had to be from news, but you see obviously a lot of buying. Then we finally make a low and my fucking cursor covered it because I'm an idiot, but you can see right there that zone I have was the low of that wick. Anybody in longs during this situation would have their stop loss below that wick because that was the current low. And if it breaks that low, that's an important area. So what does price do? It breaks that low with strength, causing those orders to get put into the market. More liquidity hits that level, boom, all those orders come in, we sweep it, boom, we go to the next fucking zone and you're like, bro, what the heck, man, why did I get stopped out? Cold world. Now let's talk about fair value gaps. A fair value gap occurs when there are inefficiencies or imbalances in the market or when buying and selling are not equal. Fair value gaps can become a magnet for the price before continuing in the same direction. Let's break down fair value gaps. The first thing we need to find out is what is an imbalance. Kind of similar to a liquidity sweep, an imbalance refers to a situation where buy orders significantly outnumber sell orders or vice versa, leading to a potential shift in asset prices. Basically a fat fucking rip. A fair value gap is basically an imbalance in the market. So all you're looking for is a big gap down in one direction and have price pull back to that area and continue down. I'm about to make this so easy for you. There are situations where it can be different, but majority of the time you're looking for a 3 candle formation. Ideally 3 of the same color candle. These are all taken from Friday, the last day I traded. I'm not hand picking this stuff. This happened literally the last time I traded. You can see price starts to fall rapidly. This is an example of imbalance in the market. We're seeing a lot of sell orders just going and going and going, sending price shooting down. We're looking for a 3 candle formation of the same color. I'm trying to make this so simple you can. The first candle you kind of want to be smaller than usual, not really indecision, but showing that price is at least holding, followed by a huge candle with very little to no wick. You can see in this situation, there really is no wick on that second candle. And the third candle, just kind of like the first one as well, holding it more than anything. And you want to chart that third candle's high to that first candle's low, in between that second candle, showing the fair value gap. And you can see price broke through it, pulls right back to that imbalance and continued down. Now it didn't dump even more. I'm not showing you perfect situations, but you did see the continuation off of that once we hit the imbalance. This would have been a winning trade. Now this one is real, but I do think this one's a little bit more unrealistic than the other one. More of, I just want to show you an example of it. You can see right here, this is on the 15 minute, I have a fair value gap marked out. Now what really points out a fair value gap for me is 2 candles in between a giant candle. Smaller candles that don't really indicate any strength or direction in between a giant fucking pickle. Now, like I said earlier, we marked the high of the first candle and the low of the second candle in this scenario. And you can see that was actually marked on Thursday. Friday, that was a news candle. That's why I really don't think this is fully legit, just because I think news had a lot of influence with this too. But just so randomly happened to stop right in our fair value gap and continue to rip up. But this is exactly what you would want to look for. And a reminder, I don't really trade with this stuff. It's something I just kind of see with my own eyes. I don't really mark out, because I like to just trade supply and demand levels. But more than anything, if you do want to learn smart money and you want to trade smart money, go ahead and do it. But I just want you to focus on just knowing more, having more knowledge in your mind, just so that even if you don't chart them out, just like I do, you just keep note of them. Fair value gaps, I think, are the most simple of them. I'm not diving fully into smart money this video, but we do have one more to talk about. If you want a part 2, smash like. Last but not least, order blocks. I think the most complicated of the 3. Probably the most, like, I guess, sought after, like the best thing, order blocks. Oh my gosh, coolest thing ever. A new study shows that people subscribe to me are 8 times more profitable. And also there's some like weird effect that like girls just start flocking to these dudes that are subscribed to me, and then they get mad at me. I'm like, bro, what the fuck? Order blocks represent an area where large buy or sell orders have been absorbed by the market and can signify a change in market sentiment and momentum. Traders look to capitalize on potential price reversals off these levels. There are different types of order blocks. I'm not going to get super deep into, and we're just going to be talking about bullish and bearish order blocks. Just like everything else on this SMC list, order blocks just represent a massive institutional purchase. I would say this is probably the most practical of the 3, just because someone who trades support and resistance levels, sometimes just end up American order blocks anyways, just because they kind of are the same thing. Within SMC, order blocks are probably the best way to look at support and resistance. So look, order blocks are basically just supply and demand. Let me break it down for you. In a situation like this, basically the concept is that big buyers and people that control the market have their orders set up at a specific point. Now, if you were someone who had enough money to control the market, you want to make sure that you do as much as you can to not lose money. So you enter at a position. In this situation, we're looking at it from a bearish perspective. And every time price comes back to that position, the idea is to make sure that they don't lose money. So every time it hits that area, instead of letting their position go negative, they shoot that bitch back down. It's literally just supply and demand levels. You're pretty much just marking daily highs and lows out and using them as support and resistance levels. The really big key here, I guess, is you can mark that entire candle. The candle we're looking at here is that green candle prior to the fall off. Now you can mark the entire thing. Me personally, I only mark the wick, so it would be kind of smaller towards the higher side of it, just because I really try to find the best entry possible. You can see twice within this example, one if I did just mark the high and one if I marked the entire candle, that we would have hit huge trades both times. It's a very simple thing. I really think people just say these cool words just to sound like they doing something, when it's really just basic supply and demand. Now I'm clarifying that this is just a very simple order block. There's like 5+ different types of order blocks, but on the front page of the book, it's very similar to just basic supply and demand. This is another example of a bearish order block. It's a lot easier to find bearish ones right now because every time we make a new high on NQ, it just never comes back down. Remember what I said, we're looking for that previous candle before the fall off. And as I was saying, I just like to mark the wick instead of the entire candle, but you can do either or. Here's an example of a bullish order block. Same scenario, but to the opposite direction. Price continues up off of it. Huge fall off. Of course, it stops right at my bullish order block. Again, the theory here is that at that bullish order block, the institutional markets are buying in. Price follows upwards. Who knows what caused that up there? I didn't really chart out this. This was just kind of for fun. I don't care enough to find out. Maybe they take profit there. Price comes back down, and what happens? The institutional buyers pick it right back up and send it back higher. Crazy, man. It's basically just a blind demand on crack. I think I snapped here. Explaining the roots of smart money concepts in the easiest way possible. I think I'm the best motherfucker on this app. The least you can do is just subscribe, bro. I'm really just trying to hit 100K so I can quit YouTube. You guys mean the world to me, but if you guys got any questions or anything, just let me know. Subscribe if you love me. You know I would do the same. Y'all boys be safe. Maybe I'll upload again in a month.